how does a credit bureau print a massive earnings beat when, high interest rates have basically frozen the U.S. housing market? Today, Equifax reported Q2 2026 revenue of $1.7 billion.
Yeah.
So that is up 11% reported.
Yeah, and 10% in local currency. And I think most importantly for everyone listening today, it beats their April guidance midpoint by $5 million.
Right. And looking at the bottom line, adjusted EPS came in at $2.25 per share.
Which is a 13% jump year over year. That actually beats their guidance midpoint by a solid 5 cents.
And the momentum just continues straight into their guidance, doesn't it?
It really does. I mean, for Q3 2026, they project revenue between $1.68 billion and $1.71 billion. And adjusted EPS is sitting between $2.15 and $2.25.
So looking at the full year 2026, we are seeing revenue guided at $6.71 billion to $6.78 billion.
Right, with adjusted EPS of $8.39 to $8.69.
Now, while this earnings print itself doesn't contain the live post-market stock reaction, these are the exact fundamental catalysts that you need to understand to trade the tape today.
Exactly. Our mission right now is to really break down the underlying segment performance, the margin dynamics.
Especially those specific ex-FICO numbers management keeps pointing to, right?
Oh yeah, we definitely have to cover those. And of course, the capital allocation that drove this beat.
So let's jump straight into what is arguably the most surprising driver of this entire report. I'm talking about the U.S. mortgage performance.
Yeah, it's wild. We are in a tough macro environment right now. I mean, interest rates are high.
Right, and the traditional narrative is always that high rates kill mortgage origination volume.
But then you look at Equifax's U.S. Information Solutions segment, USIS, and revenue actually grew a very strong 17% to $611.6 million.
Wait, and within that, B2B mortgage revenue just exploded.
Yeah.
It was up a massive 40%, with total U.S. mortgage revenue up 25%.
Yeah.
I mean, I have to push back on this paradox.
I figured you would.
Yeah, like, how on earth is Equifax printing 40% mortgage growth when the macro environment is actively working against housing turnover? Are they just aggressively raising prices on a dying volume of transactions?
Well, that is the logical assumption. But to understand what is actually happening, you have to disconnect macro housing volume from Equifax's specific market share.
Okay, so it's a market share story.
Exactly. The catalyst here isn't that suddenly everyone is deciding to brave high interest rates to buy a house, The real catalyst is VantageScore.
The alternative credit scoring model.
Yes. So back in April, the Federal Housing Finance Agency, the FHFA, they officially activated VantageScore for the mortgage industry.
Which is a huge deal.
It is a monumental structural shift for the entire sector. For years, the industry relied almost exclusively on classic FICO scores for government-backed loans.
Right, it was basically a monopoly.
Exactly. Now, because of that activation, over 1,300 mortgage lenders are actively using VantageScore.
Okay, which explains the sudden revenue spike.
Yeah.
But I really want to understand the behavior of the lenders here. Because an industry with tight margins doesn't just change its entire underwriting software overnight.
Right.
Just because a new score is suddenly allowed.
No, definitely not.
There has to be a tangible economic incentive driving over 1,000 lenders to make this switch so rapidly.
And the incentive is enormous. I mean, moving to VantageScore represents an expected $1 billion in annual savings for the mortgage industry.
$1 billion.
You're right. When you are a lender facing a tight margin environment because volume is low and interest rates are high, a structural change that promises you a piece of $1 billion savings pie is just irresistible.
Yeah, that makes sense.
It might offer more predictive power, meaning fewer defaults, or it simply might be more cost-effective to implement. Either way, the savings are accelerating lender adoption at a breathtaking pace.
And because Equifax is one of the joint developers and primary distributors of VantageScore, every time a lender adopts it, Equifax captures market share.
Precisely. So even if the absolute number of mortgages being written across the country is depressed by the macro environment,
Equifax is monetizing the mortgages that are happening at a significantly higher rate.
They have completely decoupled their revenue growth from the raw volume of the underlying market. They aren't relying on a housing boom.
They are relying on their own product, taking over the plumbing of the transactions that are already occurring.
Exactly. But, while Equifax is squeezing more juice out of a frozen housing market through VantageScore, that still relies on traditional credit scoring.
Right.
What's even more fascinating is how they are building a parallel universe of data that just doesn't care about credit scores at all.
You're talking about their Workforce Solutions segment, EWS, We see an entirely different kind of fortress against macro credit cycles there.
Yeah, EWS, Workforce Solutions, is arguably the crown jewel of the modern Equifax. This segment grew 7% to $705.4 million in the quarter.
And a huge chunk of that is verification services, which also grew 7%. Management specifically highlighted high double-digit growth in talent solutions and consumer lending.
Right.
I always think the best way to visualize EWS is to think of it as a digital toll booth for HR data.
A toll booth, yeah, that's a good way to put it.
Like every time you apply for a job, or every time you apply for a personal loan, or even when someone applies for government benefits like SNAP or Medicaid, someone has to verify your income and employment.
And Equifax owns the toll booth on that verification.
Exactly.
And they can collect that toll because their data moat is practically unparalleled in the industry. The sheer scale of what they have aggregated makes it incredibly difficult for a competitor to replicate.
Let's talk about the mechanics of that moat, because the numbers in this report are just staggering. We are talking about a database with 217 million active records, up 10% year over year.
Yeah, it's massive.
Those records cover 108 million individual Social Security numbers, and in total, they have 839 million records contributed by 5 million different companies.
What is crucial to understand here is the mechanism of how they get this data and why it is so valuable. This isn't data scraped from public websites or social media.
Or untrusted third-party sources.
Right, this is permission data flowing directly from employer payroll systems. It is pristine.
Wow.
When a lender or a government agency needs to verify your income, they cannot rely on guesswork or, outdated tax returns. They need the authoritative truth of what you were paid last week.
And Equifax provides that truth instantly through API integrations with those payroll providers.
Exactly, which perfectly explains the massive growth they are seeing in government contracts. This report notes about $300 million in annual contract value, or ACV, signed just in the first half of 2026 alone.
Just the first half. That is huge.
And if we break that $300 million down, it is about $100 million in brand new business and $200 million in renewals. The government is becoming a massive, reliable growth engine for them.
The efficiency argument makes total sense here. State and federal agencies manage massive benefit programs, Medicaid, SNAP, housing assistance.
Right, massive scale.
Historically, verifying an applicant's income for these programs meant the applicant had to track down physical pay stubs, mail them in or upload them, and a human caseworker actually had to review them.
It was a highly manual, paper-heavy process, notoriously slow and highly vulnerable to fraud.
But by plugging directly into Equifax's verification services, those government agencies can automate eligibility checks. A process that used to take weeks and cause the agency significant overhead can now happen in milliseconds.
Exactly. And the forward-looking indicator here is the pipeline. Management noted that their government deal pipeline is up 2x for 2027.
Up 2x, wow.
Yeah, this gives retail investors incredible visibility into future revenue that is completely disconnected from whether the Federal Reserve raises or lowers interest rates.
So it is sticky, recurring, counter-cyclical revenue. The government doesn't stop processing Medicaid applications just because the stock market is having a bad month.
Exactly.
Okay, so the top-line growth is clearly there, driven by market share gains in the mortgage space and this massive alternative data toll booth in Workforce Solutions. But we know that strong top-line revenue is only impressive if it actually falls to the bottom line. Let's look at margins, because this is where the accounting gets very interesting.
Oh, it really does. This is where the divergence between reported GAAP numbers and adjusted metrics becomes critical. Their reported adjusted EBITDA margin was 32.5%, which was totally flat year over year.
And a flat margin in a quarter with 11% revenue growth usually implies that costs are rising just as fast as sales, which, isn't great.
Right. But management spent a lot of time pointing out that adjusted EBITDA margin excluding FICO was actually up a very strong 120 basis points.
Beating their April guidance midpoint by 40 basis points.
Exactly.
Now, when management starts inventing metrics like ex-FICO, my immediate instinct is skepticism. It feels like they're cherry-picking numbers to make their operating leverage look better. Is there a fundamental reason we should strip out FICO costs to understand the true health of this business?
Skepticism is the right default setting, for sure. But in this specific case, stripping out FICO is vital to understanding their underlying operational leverage.
Why is that?
Because FICO scores are a pass-through cost for Equifax. Equifax doesn't own the FICO algorithm, right? Fair Isaac Corporation does. So when a bank pulls a credit report through Equifax that requires a traditional FICO score, Equifax is obligated to pay a royalty fee to Fair Isaac. And recently, Fair Isaac has been very aggressively raising those royalty fees across the industry.
Wait, so if Fair Isaac raises their fees, Equifax just passes that exact higher cost onto the lender.
Exactly.
That inflates Equifax's top-line revenue because the total bill is higher, but Equifax isn't keeping a dime of that extra cash.
Not a single dime.
It's like a restaurant being forced to use an expensive third-party delivery app. The restaurant raises the menu prices to cover the app's fee. Their top-line revenue goes up because the customer's paying more, but the restaurant's actual profit dollars stay exactly the same.
That is a great analogy.
So mathematically, that makes their overall profit margin percentage look terrible on paper. Am I understanding that illusion right?
You are understanding it perfectly. It creates a mathematical illusion of shrinking profitability. The absolute profit dollars are flat, but because the revenue denominator grew artificially due to the pass-through cost, the margin percentage compresses.
That makes so much sense.
Right, so by looking at the ex-FICO margin, which expands by 120 basis points, management is successfully showing investors that the core operations of Equifax,
The segments they actually control.
exactly, like their proprietary data distribution, EWS, and their own scoring models, those are becoming highly efficient and generating very strong operating leverage.
And to drive even more of that internal efficiency, they made a major announcement regarding artificial intelligence. They are doubling their 2026 to 2028 AI-driven cost reduction target to $150 million.
Yeah, that was huge. They are aggressively deploying what they call agentic AI across their operations and technology teams.
This is a massive piece of the margin expansion story moving forward.
Yeah, absolutely, because they aren't just talking about rolling out basic AI chatbots to handle, simple customer service tickets. Agentic AI refers to systems that have actual agency. They execute multi-step workflows.
Right. For context, a traditional AI might just summarize a document, but an agentic AI can retrieve a data file, run a complex compliance check against federal regulations, identify an anomaly, and process a transaction to correct it.
Yep.
All entirely autonomously.
And when you are a massive data broker like Equifax sitting on 839 million records, applying agentic AI to your back-end operations is the holy grail for stripping out manual labor and processing costs.
I can imagine.
It also proves that they are successfully monetizing their long, painful migration to the cloud. I mean, Equifax spent years and billions of dollars moving their legacy on-premise databases to cloud architecture.
Yeah, transitions like that for legacy companies take forever.
But now that modern infrastructure is allowing them to deploy advanced AI rapidly, resulting in this newly doubled $150 million cost reduction target. You cannot run agentic AI efficiently on legacy mainframes.
Definitely not. And, the innovation isn't just focused on cutting costs. It is clearly driving new revenue.
Oh, yeah.
They track a metric called the Vitality Index, which basically measures the percentage of total revenue coming from brand new products introduced recently. And that index sits at a very strong 16%, well above their long-term goal of 10%.
Right, so they are innovating on top of that cloud infrastructure to build products lenders actually want to buy.
So we have established they are growing the top line, and the core ex-FICO margins prove they are translating that growth into real profit. Let's shift to how that translates into actual cash and what management is doing with it.
Well, they are a cash-generating machine right now. They expect over 100% cash conversion for the full year 2026, which translates to over $1 billion in free cash flow.
But they aren't just hoarding that $1 billion in cash. Let's look at the capital allocation. First up is M&A. They just signed a definitive agreement to acquire Circulo de Credito for $750 million.
Right, this is how they are buying their way into emerging markets. Circulo de Credito is the fastest-growing credit bureau in Mexico. Over the past year, their revenue grew 31%.
Wow, 31%.
Yeah, so Equifax is using their strong domestic cash flow to plant a massive flag in Latin America, essentially diversifying their geographic footprint away from just the U.S. consumer.
Next on the allocation list is shareholder returns. They returned $366 million directly to shareholders in the second quarter.
And that breaks down into $300 million in share repurchases, retiring about 1.8 million shares, plus $66 million paid out in quarterly dividends.
Which really demonstrates to retail investors that management is committed to returning capital, even while they are pursuing aggressive $750 million acquisitions.
Absolutely.
Finally, we need to talk about the risks and adjustments to net income. because whenever a company reports adjusted EPS, retail investors have to look at what was excluded to calculate that number. The liabilities hidden in the GAAP reporting are very real.
Very real, yes. There are three notable write-downs affecting the JAP reporting this quarter.
Okay, what are they?
Well, the largest, and the one that definitely demands the most attention, is a $100 million accrual for a legal settlement related to a previously disclosed coding issue.
Let's pause on that for a second. $100 million for a coding error. That is a staggering penalty.
It really is.
And it highlights the immense existential regulatory and legal risk inherent in being a data broker. Equifax is holding the financial lives of hundreds of millions of people in their servers.
Exactly.
If your data is wrong, or just a single line of code misallocates a credit score and causes someone to be denied a mortgage, the consumer harm is immediate and the regulatory fines are brutal.
It is the dark side of the data moat, for sure. The data is incredibly valuable, but the liability of managing it is equally massive.
Yeah. What were the other two adjustments?
They are smaller, but still worth noting for cash flow purposes. There's $7 million in acquisition-related costs, likely tied to the Mexican Credit Bureau deal.
Sure.
And $4.6 million in restructuring charges tied to their ongoing cloud technology transformations.
All right, so management backs these out of the adjusted EPS because they view them as one-off or transitional expenses. But they do impact the raw cash position of the company today.
Exactly. They still have to pay that cash out.
Right. Well, we have covered how they are defying the mortgage paradox with VantageScore, how the EWS digital toll booth is capturing government contracts, the math behind the ex-FICO margin expansion, and how they are allocating $1 billion in free cash flow.
We covered a lot of ground today.
We really did. As we wrap up this deep dive, I want to leave you with a forward-looking question to mull over regarding Equifax's entire evolution.
Yeah, it really is a question of what kind of company they're becoming, isn't it?
Exactly. If Equifax is successfully deploying agentic AI across its operations, and they're doing it on top of a proprietary permission-only data moat containing 839 million records that competitors simply cannot replicate, or are they still just a credit bureau?
Right. Or are we looking at the foundational architecture for fully autonomous, AI-driven financial underwriting?
Exactly. Because if Equifax owns the pristine data, and they are building the autonomous AI brain that interprets that data, they are positioning themselves to capture infinitely more value than just selling a traditional FICO score to a bank.
They are transitioning from providing the raw ingredients to essentially cooking the entire meal for the financial sector.
It is a massive shift and is something to keep a very close eye on as this AI narrative plays out over the next few quarters. If you want to stay ahead of the curve and get this kind of no-fluff fundamental breakdown on the numbers that actually move the market, make sure you hit follow on this deep dive show for our daily earnings coverage. See you on the next day.